Good morning. I'm Victoria McEwen, Managing Director at Glenigan, and welcome to our webinar, where we'll be discussing our construction industry forecast for 2021 and 2022, which, if you're joining us live, was released last week. If you haven't yet read a copy, the link is now on the screen. 2020 has been an unprecedented period for UK construction, with on-site activity throughout lockdown 1 being severely impacted due to the coronavirus pandemic. But it's also been a period where the industry has shown its resilience and its resourcefulness, which enabled sites to get back up to speed quickly and safely, and has seen the market bounce back much quicker than first anticipated. But now, with a second lockdown looming upon us, with the Brexit looming, how will the industry recover? With yesterday's announcement of a step forward in the search for a vaccine, what does the landscape of the market now look like? Well, to answer that, I'm joined by Alan Wellen, our Economics Director and author of our forecast.
Good morning.
Robert Davis, our Content Director.
Good morning.
And George Reed, Policy Executive and Political Intelligence Provider at DeHavilland, who will give us his insights into Brexit.
Good morning.
We'll be running a Q&A session shortly, and if you're watching us live, then please feel free to submit your questions in the chat. But firstly, let me pass to Alan to give us some insight into his forecast for the industry.
Thanks, Vicky, and good morning, everyone. Over the next 10 minutes or so, I want to review how the UK's construction performance has fared over the last 9 months and how we expect construction to move forward over the next 2 years. As Vicky was saying, the construction industry has battled with unprecedented market conditions this year. The COVID-19 pandemic has dramatically reshaped the outlook for UK construction activity, as it has for the world and UK economy. The national lockdown during the spring had a dramatic impact on the UK economy and construction during the second quarter. However, the construction industry moved quickly, adopting COVID-safe working practices, and as a result, sites reopened more rapidly than initially feared. Project starts declined by around 47% during the second quarter against a year earlier. Now, whilst that's clearly very sharp, the fall is by comparison is a lot better than perhaps anticipated at the time, where we anticipated 68% decline at the time of the forecast. And it just shows how rapidly the industry was able to respond and reopen sites. Construction starts subsequently recovered during the third quarter and were in line with the June forecast. Whilst recent weeks, we have seen a sort of a tightening in COVID restrictions, including a new national lockdown, measures have not been extended to a new lockdown of construction sites. However, other parts of the UK economy are suffering, and that disruption is lasting longer than anticipated in June. This is damaging the financial position, confidence and investment intentions of private sector firms and consumers. As UK construction gradually recovers over the next 2 years, the pattern of the industry activity is set to shift, reshaped by the changes in the wider economy, as well as government policy and social changes in the aftermath of the pandemic itself. In addition, Brexit will also reshape the industry's fortunes. Under our central forecast, the UK will leave the Brexit transition period at the end of this year with a limited free trade agreement in place with the EU. Near term, new customs regulations and non-tariff barriers are expected to disrupt supply chains across the UK economy. This will disrupt and delay the economic recovery from the pandemic, dampening the upturn in private sector construction activity over the next 2 years. In contrast, we expect greater public sector investment to be the major driver for construction growth during 2021 and 2022. Overall, we anticipate that construction starts will grow by 17% next year and by a further 9% in 2022. Given the exceptional high level of uncertainty, however, over the outlook for the economy arising from both the pandemic and the change in the UK's future relationship with the EU, Glenigan has again prepared 2 alternative illustrative scenarios alongside our central forecast, as you can see from the chart on the screen. The assumptions behind these are set out in the report itself. Turning now to look at the individual parts of the industry in more detail, starting with the residential side. The national lockdown in the spring hit private housing activity especially hard during the second quarter. Furthermore, as suspended projects were reopened and sites restarted, house builders prioritised sites which were closer to completion rather than opening new sites. Alongside that, the wider housing market was also effectively frozen during April and May, but has been surprisingly robust following the end of the lockdown. Indeed, house prices rose by 5.8% during the year to October, and the number of mortgage approvals have reached a 13-year high. Glenigan's sister company, Groundshaw, has also seen strong demand for residential property searches from conveyancing solicitors acting on behalf of home buyers. The current mini boom in the housing market has in part been driven by pent-up demand and a temporary reduction in stamp duty rates. But there also is an apparent shift underway in buyer interest towards larger properties in smaller towns and villages, and that has been sort of driving the current sort of rise in house price inflation. However, activity in the wider housing market is expected to cool over the coming months as the labour market weakens and a temporary stamp duty reduction finishes in March. Lower turnover in the wider housing market is expected to dampen new house sales, limiting the recovery in private housing starts during 2021. Looking further ahead, improved trading conditions in the wider housing market are subsequently expected to lift new house sales and sustain private housing starts during 2022. Student accommodation has also faltered during 2019 and 2020. Whilst the pandemic has directly disrupted starts this year, it is also expected to have a longer-term impact and implications for the purpose-built student accommodation market, which is disproportionately dependent upon lettings to overseas students. While the value of student accommodation starts are forecast to improve over the next 2 years, starts in 2022 will still only be at half the level of their peak year in 2018. Conversely, housing associations are now better placed to finance and take forward new developments following the relaxation of government restrictions on rent increases. In addition, the government is expected to increase sector investment as it seeks to honour both its election commitments and to kickstart the UK economy. Affordable housing activity picked up during 2019. Whilst the pandemic has caused a short-term hiatus in starts this year, renewed growth is anticipated from 2021 onwards. Turning to the industrial sector, strong demand for warehousing and logistics space is expected to drive the forecast recovery in industrial building work over the next 2 years. Demand for logistics space is being principally driven by structural changes in the retail sector, with the relentless growth of online retailing, click and collect, and home deliveries fueling the demand for warehousing and distribution premises. The pandemic itself has accelerated this trend. Online retailing has surged during lockdown, with many consumers becoming regular online shoppers for the first time. Online purchases have accounted for 28% of all retail sales since March, and this compares with just 19% of retail sales during 2019. Alongside this trend, the potential disruption to supply chains following the reintroduction of customs controls with the EU is likely to fuel additional demand for precautionary warehousing space for manufacturers and distributors. In contrast, UK manufacturing faces weak domestic demand and overseas demand as well. Against this background, we anticipate a continued weakening in manufacturing investment in new or expanded premises. The pandemic is also reshaping the demand for commercial premises. Whilst the pandemic has boosted demand for logistics space, it has exacerbated the woes faced by more traditional retailing. Retailers will face challenging market conditions over the next 2 years. Although overall retail sales have improved post-lockdown, there has been a marked shift in consumers' habits. With new store closures during the run-up to Christmas are likely to further cement those changes in consumer habits for the longer term. Against this backdrop, the retail property market faces weakening demand for retail space and softening rental values. We expect project starts to fall by 40% this year, and the subsequent recovery is forecast to be slow, with starts rising by 14% next year and a further 16% in 2022. The leisure and hospitality industries are being especially hard hit by the pandemic. The collapse in the number of overseas visitors to the UK and the COVID regulatory restrictions on facilities operations have damaged the financial viability of many operators in the sector. Project starts have fallen by 30% this year and are expected to weaken further in 2021. Turning to the office sector, where office starts are forecast to decline sharply this year as the pandemic exacerbates a cyclical downturn in sector activity. The value of project starts is forecast to weaken further next year before strengthening in 2022. The widespread use of remote working during the pandemic has prompted many organisations and individuals to review their need for the daily commute to the office. As more people in the future work away from home at least some of the time, away from the office at least some of the time, firms are expected to reappraise their accommodation needs. Near term, this is forecast to spur an increase in refurbishment work, as firms remodel existing premises to create more collaborative spaces over the next 2 years. New build office projects are likely to be slower to recover as occupiers and developers reassess the longer term demand for office accommodation. Turning to public non-residential and civil engineering activity, where whilst conditions are expected to constrain the pace of recovery in private sector construction activity, increased government investment is forecast to lift publicly funded areas such as health, education, and infrastructure work over the next 2 years. An increase in school building projects is forecast to drive a recovery in the education sector activity during 2021 and 2022, as local authorities tackle a shortage of secondary school places. The number of secondary school-aged children in England is projected to have risen by 14% over the 5 years to 2022. Additional places are needed, particularly to accommodate those children, especially in the major metropolitan areas. Looking ahead, the government's pledge to increase capital investment should help to increase the funding available to local authorities to invest in their school estate, although the extent of the central government support that will be available will have to await the delayed spending review next year. Further education work is also forecast to rebound over the next 2 years. The value of further education projects securing planning consent during 2018 and 2019 was 46% up on the preceding 2 years. Many of these projects have yet to start on site and are expected to help lift education activity further from 2021. A fall in universities' capital spending, however, is expected to temper the overall growth in the education sector. Universities face increasing funding pressures from a weakening in UK student numbers. The pandemic has exacerbated universities' financial problems, with the number of higher fee-paying overseas students also expected to fall. Turning to the health sector, where the outlook is bright, the NHS could not be higher on the political agenda. The Nightingale Hospitals has already lifted project starts during 2020. Prior to the pandemic, the government had already promised additional funding with an extra 20 billion committed to the NHS over the next 5 years. Encouragingly, a previously weak development pipeline has begun to grow. Having declined for the last 2 years, the value of health projects securing detailed planning consent rose 14% during the first 9 months of 2020. Looking ahead, the promised additional government funding will begin to feed through to sector activity from next year. Starts are forecast to maintain their upward momentum, rising by 11% next year and 12% in 2022, as NHS trusts develop and implement their investment programmes, including the work to deliver the 40 new hospitals promised by the government over the next 10 years. Whilst civil engineering project starts, along with other sectors, were disrupted and delayed by the lockdown, the sector is set to recover strongly over the forecast period. The government has pledged to significantly increase investment in the UK's infrastructure. Government announced that the second road investment strategy will total over 27 billion between 2020 and 2025, and will include a number of major road projects. While some of these projects will take time to be shovel-ready, they may boost the sector towards the end of the forecast period. Nearer term, we anticipate that additional funding will be directed at starting smaller improvement schemes and areas such as tackling the maintenance backlog on the nation's roads. At 50% increase to local road maintenance budgets for 2020-2021 was announced as part of the last budget in March. Civil engineering workload will also be lifted by the water industries and Network Rail's 5-year investment programmes, which will gather momentum over the next 2 years. In addition, existing major infrastructure schemes, including the Thames Tideway, HS2, Hinkley Point, will all also be important drivers for sector activity over the forecast period. So overall, we anticipate a sustained recovery in construction activity over the next 2 years, a period during which the UK economy will be gradually recovering from the COVID-19 pandemic, while also facing Brexit-related disruption to trade and growth. Construction starts are forecast to rise by 17% in 2021 and by 9% in 2022. By the end of the forecast period, the value of underlying starts is set to total 49.3 billion, around 77% below 2019 levels. However, the composition of the market will be different. New opportunities are set to emerge. Greater public sector investment is set to drive growth in health, education, social housing, and civil engineering. Structural changes in the economy will also generate new opportunities in office refurbishment work and in logistics and warehousing. Thank you.
Thank you, Alan. It's great to see that the impact was less than our worst predictions throughout 2020, and just how well the industry has responded to COVID, which gives us, a positive start to dealing with the challenges and the opportunities that we have ahead of us. Now, we've got lots of questions coming in. We'll dig into those in more detail in our Q&A session. But firstly, let's go over to George Reed at DeHavilland, who will share his thoughts on Brexit. George, over to you.
Well, thank you very much, Victoria, and good morning, everyone. I want to expand on my piece within the Glenigan forecast, which can be found on page 12. And at DeHavilland, we've really been following these negotiations really closely on a daily basis since the UK left the EU at the end of January this year. But over the next few minutes, I'm just going to talk about the current state of negotiations and then go into a little bit more detail about 3 potential permutations of what the UK status could be with the EU come the 1st of January 2021. But first, let's assess the timings of the negotiations. So they're ongoing as we speak, and they're scheduled to continue until Thursday, although the expectation is that Mr. Barnier and Lord Frost will extend these negotiations to the end of this week. Both sides are looking at a mid-November deadline for a deal. Now, that's not just political, it's logistical as well, because there are lots of time pressures attached to translating the agreement, but also ratifying it. And internally within the European Parliament, the current plan is for the European Parliament to vote on this final deal, if it comes, on December the 16th, following scrutiny from the relevant committees. But where is there disagreement between each side? Why hasn't there been a deal done already with only days to go? Well, the first issue is the level playing field. there's disagreement over this level playing field, and strong concerns from the EU that the UK would have excellent access to the EU's single market, whilst also being able to diverge from EU standards and possibly gain a competitive advantage. There is also concern around fisheries between both sides. So the UK want to move away from a system which Lord Frost feels gives too much of the UK's waters away under the common fisheries policy. But the EU probably wants a system which is far closer to the current status quo. But then there are also other issues at play. There's an issue around data adequacy and security, which will have huge impacts, particularly in terms of data access to European businesses for the construction sector, but also debates over the UK's future security arrangement. So it's a very multifaceted debate that's going on at the moment. But clearly, we can't really talk about the discussions and the debate between the EU and the UK without mentioning the famous Internal Market Bill. And the Internal Market Bill gives power to UK ministers over previously settled withdrawal agreement provisions. And there are a couple of really important clauses within it that are deeply unpopular with the EU and also with some members of the House of Lords as well. And these are clauses 42 and 43. Which could allow ministers to modify or disapply rules relating to the movement of goods in Northern Ireland. I mean, essentially allowing a unilateral changing of the withdrawal agreement. Now, last night, the House of Lords did reject a series of these clauses in a really heavy defeat for the government. But the government has already come out and said that they're going to retable these clauses and say that they're essential to managing Brexit in the future if there is a no-deal exit. However, just away from that, sentiment has shifted in Brussels and in terms of the argument. Boris Johnson says there is a deal to be done, and we are moving closer in terms of these larger, more thematic areas of disagreement, particularly on state aid, where I think UK assurances on maintaining high standards could be enough to satisfy Brussels. Similarly, a quantitative negotiation on fish stocks could be a landing zone for negotiations on fisheries. But what we know about EU negotiations is things happen at the last minute. But I'm quickly going to analyse what the three options are, where we could be on the 1st of January. And the first option is, of course, a deal between the UK and the EU. But I think it's important to quickly explore what the reality of a deal will be between the UK and EU. First of all, the UK is leaving the customs union and it's leaving the single market. So there will be new trade frictions, there will be customs checks, there will be new regulations on things like rules of origin. So all in all, this deal is likely to be a thin one, which would get rid of tariffs, which is hugely important, but it will still apply considerable administrative burdens on businesses. And it'll be light in detail in terms of professional services as well. Procedurally, how do we get to a deal? Well, actually, it's not that difficult for either side to get to a deal in terms of procedure. The UK government doesn't actually need a final vote on the deal, although it may need some primary legislation to introduce some of the provisions. And the EU should only require ratification from the European Parliament and from member states due to the simplicity of a deal if it comes. So the benefits of a deal, well, clearly it will establish some political goodwill to build on. It'll allow streamlining of the red tape that we will see on the 1st of January. And it'll protect businesses and consumers from a no deal in terms of those tariff barriers that would happen otherwise. But just as a sort of insight, maybe to the downsides to those that are expecting a very fluid deal, it will not be a Norway-esque agreement. There will not be near frictionless trade. And the Institute for Government have very recently warned the UK government that the general public need to be made aware of the fact that there is not going to be this frictionless relationship on the 1st of January. But what's our second option for an agreement? Well, the second option is where these thematic disagreements remain, but both sides decide to avoid a no deal and agree to a kind of package of measures which avoid a kind of full-scale rupture like we would see in the case of a no deal. So, for example, an agreement could be reached on energy, on security and data provisions, on aviation. And the benefits of that are clearly it avoids a no deal. It would be unclear as to whether or not tariff barriers are erected or not, but it would avoid the political issue of a no deal. It's also a political option for Boris Johnson to say that he avoided a no deal in the context of COVID-19. But the downsides to this, well, the EU have said that they don't want to do a series of mini deals. It would also lead to significant trade friction. It would provide insecurity for business because they wouldn't know what the future holds. And it would also beg the question that if the UK and EU were unable to get a deal in 2020, well, what's the difference between 2020 and 2021? And then, of course, we arrive at the final main option that the UK and EU have, which is, of course, a no deal. And it's important for us to note that this is the legal situation if a deal or a tied over agreement is not reached. So tariffs would be applied on 90% of UK goods exports. It would provide the highest level of administrative burdens when it comes to trade. And I can go into a little bit more detail later in the Q&A about the nature of a no deal Brexit. But are there any potential benefits? Well, the Prime Minister would see a benefit in being able to say he kept to his word that no deal is better than a bad deal. UK wouldn't be bound by state aid rules, wouldn't be bound by the ECJ. And also there are provisions in the withdrawal agreement to protect citizens' rights. But what are the downsides? Well, the London School of Economics predicted that a no-deal Brexit would not just be worse than COVID, it could be 2 to 3 times more expensive as COVID-19, which very much puts it into perspective. Major tariff barriers, again, huge administrative barriers and burdens for businesses, but also in a less tangible way, a breakdown of that political trust between the UK and the EU, especially if the UK decides to invoke those provisions that I spoke about earlier in the Internal Market Bill. So to conclude, there are more positive noises coming from Brussels and Westminster. And it's my view that it's likely a deal can be done. Boris Johnson has said a deal is there to be done in the form of a free trade agreement. And that, to me, seems like the most likely conclusion, looking at the nature of these agreements. But then again, a shorter, slimmer political arrangement, which the EU and UK could build on, is certainly a possibility. And of course, it's very important for us to note that a no-deal Brexit is absolutely still on the table and a very possible scenario. But much of this is going to come down to the optics of a deal. The EU are going to need to come out of this having protected the integrity of their single market, and the UK are going to need to sell this deal as providing access to the EU market, but also sovereignty from the EU institutions and arbitration systems, and the phrase "taking back control." That's very meaningful to the current government. So, as ever, DeHavilland are going to continue following these negotiations very closely, and it'll be interesting to see what happens in the coming weeks and months.
Thank you, George. Certainly a lot of work still to be done between now and December the 16th, which seems like a great place to start our Q&A session, actually. And George, with your predictions of a thin deal or a tie-over agreement being one of the potential likely outcomes, what impact specifically do you see on the construction industry?
Well, Vicky, it's such an interesting question because it's a really multifaceted answer that you have to give. There are so many moving parts here. But I'll start off with perhaps the most obvious one, which is around the tariffs and the regulatory barriers. And to sort of set the scene, in 2010, of imported construction materials into the UK, 64% of them came from the European Union. So if we're looking at a situation of inevitable administrative burdens and potential tariffs on top in the case of a no deal, this is going to be highly disruptive to the construction sector. That's fairly obvious. So in terms of those sectors where it really matters for a deal to be done, I would say that the construction sector is right up there. But then there are wider considerations that are hugely important to the sector. So skills, for example, we've just seen the immigration bill, which ends the free movement of people, move through Parliament only yesterday. And it'll be really interesting to track what happens with demand for EU labour. Back in 2018, the CIPD said that 2/3 of organisations have said that they want to recruit EU nationals. So look, I think it's very fair to classify a skills shortage as a major risk factor, and especially due to upward pressure on wages in the UK due to that potential shortage of skilled workers. That said, the government would rebut that and say that the purpose of the immigration bill is to just continue matching supply of labour to employer demand. I suppose the proof will be in the pudding as to how well that bill performs. I think another really interesting consideration will be investment in infrastructure. So the UK is obviously losing access to the European Investment Bank. In 2018, the EIB invested 7.8 billion euros in infrastructure projects. They're going to miss out on the EU's recent recovery package, which is worth 750 billion euros in response to COVID-19. So there are pots of money that the UK will not be eligible for anymore. So it will be a question of whether or not the UK, in terms of making those savings, reinvest them in infrastructure investment. Who knows? But clearly COVID-19 is going to put huge fiscal pressure on the Chancellor. And I think there's one final point I'd make in terms of construction, and that's autonomy. And I think at DeHavilland, one of the things we really feel is that construction is one of the key sectors which is at risk of a regulatory conundrum in terms of EU-UK divergences. So just in terms of the EU's plans, the EU has major plans for a renovation wave of EU buildings, where they want to at least double renovation rates in the next 10 years. So that's going to amount to around 35 million buildings across the EU being made more energy efficient. But we're also going to see the revision of the construction products regulation, major changes to industrial emission rules, the potential extension of the emissions trading system to buildings. So what we could see from 2020 to 2030 are major regulatory differences between the UK and EU construction sector. And what does that mean for the UK access to the EU market? Time will have to tell, but it's certainly a very interesting thing to analyse going forward.
Indeed, thank you. And a question that's just come in while you've been talking, George, actually, and it's one for Alan, which is just with the potential tariffs and regulatory barriers, what will the impact be on the ground for construction? Where are we going to really feel this?
I think if you look at the market as a whole, 90% of the products used in the UK are sourced from the UK. But as George was saying, where we do import, 60% of them come from the EU. And in some parts of the industry, it's a much higher proportion than that. 90% of timber, for example, is sourced from overseas because, frankly, we just don't have enough trees in the UK. So that could have a colossal impact. So you could imagine if there's a sharp increase in tariffs, or even if there's just great administrative burdens, you could be looking at delays in supply, and that could really impact on terms of the timing and cost and delivery of projects. Housing, for example, is obviously particularly timber dependent. Other sectors as well, particularly on the sort of the air conditioning and more high-tech product side of things, a lot of those are imported. We have a good two-way trade with the EU in those products, but the products we might be exporting may not be the ones that people particularly want to specify on the actual project they're working on, which is why they're being imported. So there's a real risk of disruption, a need to perhaps review specifications if there's a danger of projects being delayed, to make sure that actually you're still selecting a suitable product, but you're not going to interfere with construction programs at the same time. So it could be there's a real risk there.
Indeed. And just sort of moving slightly closer to home, Rob, we know that the first lockdown had a huge impact on construction activity. How are we seeing the second lockdown impact on the industry now?
Yeah, well, as you know, we monitor all the projects that are on site, and generally speaking, there's between about 10 and 15,000 projects, large projects on site at any one point in time. And during the last lockdown, it reached around about 40% of projects which were on hold due to the COVID restrictions. We did find, though, that the industry quickly responded, and the amount of sites that were suspended dipped right down pretty quickly, actually, throughout May and June, back right down to only about 2% of projects continuing to be locked down. Now, obviously, regionally, there was a bit of a mixed bag, because Scotland and Northern Ireland were still under some quite tight controls there, so they stayed locked down a lot more. However, since lockdown 2, if we'd like to call it that, we've not seen sites being locked down at all. What I think the Prime Minister was very clear in his announcement that that construction remains open, that all the trades can continue, that builders, merchants can stay open, that it's possible even for tradesmen to go into people's houses and carry out work. So I think that was made quite clear. Also, I think it's been quite impressive, as Alan touched on, about how quickly the industry's adapted. And how well it's adapted to social distancing, to reducing the number of heads on site, but working on productivity levels to try and improve, extended working hours, these sort of things, to try and ensure that projects aren't delayed too much by having a reduced amount of headcount actually on sites. So I think overall we're seeing much less of an impact than we did with lockdown number 1. I saw some announcement from the Child Institute of Purchasing and Supply yesterday that its optimism index, if you like, was above 50 and has remained above 50 every month since June. Now, anything over 50 means that the purchasing managers are seeing a growth. They're expecting growth going forward. So I think that that's very, very positive. And the industry generally is responding really well to the restrictions around lockdown.
Which is, great news for the industry, as you say, Rob. And just in terms of our database, obviously, Glenigan has a very unique view of the construction market. What's the database telling us about the market sentiment right now?
Well, generally, I think we're quite optimistic, actually. There hasn't been a decline in planning activity. That's the first level. We're seeing stronger than ever approval levels, actually. And so therefore the sentiment, the confidence from developers is still there. Following a bit of a subdued period over the last couple of years because of the Brexit uncertainty, 2020 has been a bit of a roller coaster, really, for planning approvals. It starts off really high with the Boris bounce, as it was called, after there was certainty about Brexit, and then of course COVID hit, so it dropped like a stone throughout March and April. But then ever since May, it's been increasing every single month consecutively. And now we're in a higher level than we were at any time over the last 2 or 3 years. So there's lots of planning activity going through. We've also spotted an uptick in tender activity. And this is particularly over the last around about 6 weeks. Throughout October and the start of November, we're adding now over 100 bidders to projects every working day, which is up about 10% on where it's been at a sort of pre-COVID level. So we're seeing a lot more activity around the tender side of things. And just anecdotally, our researchers are hearing positivity and a sense of urgency about getting projects moving and getting them up and running. I think, as Alan mentioned, the private housing sector is the largest single sector. That's been troubled over the last sort of few months, but it's now becoming a particular growth area. Taylor Wimpey yesterday saying its order book was up 11% year on year. Redrow has seen turnover up 48% over the last 5 months compared to this time last year. But interestingly, there's a big regional split with that. They were saying that regionally they're up 17%, but they've pulled out of 3 of their 6 major London sites. And I think that tells a story in itself. And with civil engineering, of course, we know that there's lots of large contracts coming throughout 2021 and 2022, as Alan's alluded to. And that's alongside other publicly funded projects. The government's looking to, I think, jumpstart the economy. It's looking to push investment. It knows that by building stuff, it can trigger in further investment, create jobs, create assets for the country. So it's seen as a really good investment. And I suppose the other element to think about is contract awards. And if anybody's seen in today's Construction Inquirer feature on the Glenigan data that we provide on the league tables of top contractors, you will have seen that the total awards are now back to pre-COVID levels, with civil engineering actually running ahead of this time last year. So with that kind of pent-up increase in tenders coming through that we can see, that will obviously have an impact around about the end of the year, start of next year as well. So I think there is a good level of optimism going into 2021.
Which is very good news for us. And look, to see an increase in activity in both planning approvals, planning submissions, and tenders and contract awards is brilliant for the industry overall. I guess the question that we can't answer right now is how many of those planning approvals and planning applications will translate into project starts, and whether investor confidence will wobble. But that will be only a time will tell situation. So look, I just want to deal with the questions that are coming in over the live chat, because certainly an awful lot of questions around the office sector and how this might evolve throughout certainly the pandemic and going into next year. Someone asking, will empty offices, shops and pubs be converted into housing, in our opinion?
Well, I think the recent I was going to say the recent changes in planning legislation means that the government are trying to make that happen. They've simplified the planning use classes so that therefore it's easier to convert something from office use, commercial use into residential use. But I'm not convinced that the demand will be there for high-rise flats in major conurbations. Alan, I think you were alluding to this in your piece earlier.
Yes, yeah. I mean, I think this is one of the as you say, this is one of the issues at the moment. It's going to be it'll be interesting to see how it plays out in the longer term. But certainly at the moment within the housing market, there's a lot of interest in actually people saying, actually, I want to move to a bigger home out in the countryside. If I'm not going to be having to commute into the office every day, I don't need to live so near to the office. And if I can find somewhere with a bit more green space, particularly in the current COVID restricted environment, that's got to be a win. So that's been one of the things that's been fueling the housing market activity, certainly in the sort of over the last sort of a few months. It'll be interesting to see how whether that's maintained over the longer term. But certainly, clearly, that I do think there is if more people are going to be working remotely, then actually maybe they don't need to be living in the city centre, so to speak, unless they want to have the social life aspects to it. And again, obviously at the moment, that's very, very much closed down because of the COVID restrictions. But that could be one of the things that perhaps appeals to both younger and older generations of living close to where all the facilities are going forward, but perhaps not less so for families.
And just touching on that housing piece the housing piece that you just mentioned, Alan, do you think it's likely that the government are going to extend the stamp duty holiday, or at least stagger it in order to keep the private housing sector stimulated? We've
assumed in our forecast that they've said it's going to end in March, and that's when it's going to happen. But I think there's clearly a case for extending it, and there's also a case for not announcing that you're going to extend it until you get very close to the date. Otherwise, people are going to take the pressure off, so to speak. But clearly, that has been a key driver for the market over the last the last few months. And in fact, a lot of the pipe. I think one of the house builders saying actually they've got a lot of completions lined up for after that. Because people have been rushing to buy, but actually completion is due after that deadline. So again, that's a sign of there's a dichotomy perhaps they're going to find themselves in. There's clearly a good case for extending it.
Yeah. Jumping back slightly, was a question that came in, George, while you were talking, and that was just about what's the justification as to why a no-deal Brexit would cost 2 to 3 times more than COVID?
No, absolutely, and it's a very good question because it's quite a staggering statistic. But yeah, looking at the LSE data, it says that the long-term economic hit from a no-deal Brexit is at 8% of GDP, which is actually very much aligned with the UK's 2018 UK government's 2018 forecast of 7.6. So actually, it probably is around that area, and that amounts to about 160 billion pound hit to the UK economy. Now, if we look at the Bank of England's COVID impact assessment, it shows a 1.7% reduction in GDP and a real money impact of 40 billion pounds to the economy. So clearly, it could be 2 to 3 times more impactful a no-deal Brexit. Now, that said, it's important that we look at some of the context to that and some of the factors that may decrease or increase that no-deal Brexit impact. First of all, that's working on the assumption that we remain in that state of no deal. Which is absolutely not an inevitability, because some people in Brussels are very much saying that a no-deal exit would just be the beginning and that the pain would force the UK and EU back to the negotiating table for a deal. And it also makes a number of assumptions around future trade agreements that the UK conducts, and we don't have a huge amount of information about the nature of those trade agreements. So it's very much a statistic that should be taken with a pinch of salt. But forward looks to quite a damaging no-deal Brexit if these statistics are right.
I think it's as you say, George, it's the long-term aspect to it, isn't it? Really, if it does continue in that sort of no-deal status, that's where you get the 8% loss. Whereas I think the thing with COVID is we've had all the pain very much concentrated into this year and a little bit into next year. So so we are going to bounce back from very rapidly from the COVID pandemic. Not as quickly as perhaps everyone was hoping in June, but the recovery is already underway.
Thank you. And to go a bit further afield now, actually, a question coming in is, whilst we talk about the political landscape, George, do you have any insight into how the US election is likely to impact the UK market?
Well, it was a fascinating election to watch, and it's been a fascinating election to watch the kind of fallout from. I mean, in terms of the US and UK market, a lot has been made of the UK's trade relationship with the US after Brexit, and whether or not a Biden administration would give a better or worse deal to the UK. Now, I think there are a couple of arguments at play here. I think one of the prominent ones is that Joe Biden has been very outspoken about the preservation of the Good Friday Agreement, about the Northern Ireland Protocol being followed very, very closely, and would likely be very frustrated and hesitant to give the UK a trade deal, whilst the provisions of the Internal Market Bill, which gave the UK unilateral say over state aid in Northern Ireland, amongst other provisions, is definitely something to analyse. I can't absolutely say that Joe Biden would not give the UK a trade deal in that circumstance, but he certainly seems a lot more hesitant than perhaps Donald Trump would under that administration. That said, I think it's very much worthwhile to analyse the political sentiment around Joe Biden, possible UK public trust in his upcoming administration, and that a trade deal between the US and the UK would perhaps go down better under Joe Biden than it would over Donald Trump. Concerns over pharmaceuticals, etc. So it will certainly be an interesting one to watch. But on the side of that, to also see the development of this internal market bill and the UK's compliance with the internal market with the Northern Ireland Protocol.
Indeed. Well, look, thank you, gentlemen. Unfortunately, we are going to have to draw our discussion to a close. I think we could continue talking about multiple topics throughout the morning, but it's clear that the industry is currently in a challenging position. But I think it's important that we focus on the positives and how the industry is responding to that challenge and the new opportunities that the market now presents. Greater public sector investment is fueling a recovery in social housing, health, schools, civil engineering, and major projects are further boosting civil engineering workloads. The pandemic has forced businesses to question their office requirements, which is driving a rise in refurbishment work as premises are remodeled. And a surge in online shopping has driven a boost in investment in warehousing and logistic facilities. So whilst the recovery will take time, there are opportunities emerging that are there to be taken advantage of. So thank you for joining us today. And we would like to remind you, if you require any specific analysis around your industry sectors, or if we can help you identify new business opportunities, then please do get in touch with us at Glenigan. But for now, my thanks go to Rob, Alan, and George, and to you all for taking part in today's webinar. Stay safe and goodbye.